Hi, you're listening to Tangents, a podcast from Coin Center. I'm your host for this week, Peter Van Valkenburg, Coin Center's Director of Research. And my guest this week is Abe Sutherland, who is a legal advisor to the Proof of Stake Alliance and an adjunct professor at UVA Law. Abe, thanks for coming on Tangents.
Glad to be here.
So I wanted to quickly just summarize why I thought you'd be an excellent guest for this podcast. So Coin Center, for those of you who know our work, of course, has long had two big tax priorities as far as how we could improve public policy towards cryptocurrencies in the tax realm. And those have been a de minimis threshold for capital gains taxation so that people could actually use it as currency. And there's some legislation that we've been trying to get through Congress for a few years now that would fix that problem. And common sense treatment of forked assets, which is a whole bee's nest of issues that the IRS has kind of made worse by misdescribing forks and airdrops and conjoining those two phenomena in crypto. But we now, and as of maybe about a year and a half, have a third big priority in the tax policy world that we came to because we read a paper that you wrote, Abe, and published about how block rewards are taxed. And I think a lot of people in the crypto space think, well, that was early on. The IRS came out and said, if you mine Bitcoin and you earn Bitcoin through mining, we're going to tax that as income. That seems straightforward, but you've got some excellent thinking that I think shows that it's not straightforward and it's maybe not the right answer. Is that about right?
That's exactly right. And, we'll talk about the history and how that 2014 guidance has informed where we are now. But of course, the issue and its importance is really tied to the advent and development and now the explosion of proof of stake technology. And, kind of at the core of my tax theory and arguments there, really also gets to a theory or a way of understanding something critical about a public cryptocurrency, which is how it's funded, how the maintenance is paid for in a way that maintains the security of the network. And it just turns out that this issue of tax is really where that question takes on tremendous public policy and practical significance for cryptocurrency.
So you say it sort of came up for you most notably in the case of proof of stake and the rise of that technology. Is that because you're more likely to find sort of average ordinary persons staking versus the sort of more commoditized, industrialized, like proof of work mining? Or is it because of the frequency of block rewards?
Yeah, it's only part of it, but part of the explanation of why the 2014 advice didn't really matter has to do with kind of the numbers involved and how many U.S. taxpayers. This is a global issue, and hopefully we'll talk about that as well. But with the focus right now is on U.S. law. But it's more than that. It's also the number of people implicated in this, given the way proof of stake technology works, and as well a phenomenon which is much more clearly identifiable in the proof of stake context, which is comes to the question of the level of tax or the statement of gain on which income tax is paid. And the fact of overtaxation, which is a big emphasis of mine, is something that you really you really only see and appreciate in the proof of stake context.
Okay, so maybe try and lay that out for our listeners. Like, why would you be overtaxed if your proof of stake rewards, to start with proof of stake, were treated as income?
Right. Let me start with kind of a statement of the basic issue, which
Sure.
in a sense we haven't kind of quite gotten to. In a sense, it's very simple, right? We have an income tax. The government taxes something called income, which, without being too specific, is kind of your gains, your improved wealth over the course of a tax period, which is the year. Block rewards are, and reward tokens are these new tokens that come into existence as a part of the complicated, fascinating incentive mechanism to ensure the ongoing 24/7 maintenance of these cryptocurrencies.
Yeah.
the question is, in a sense, very simple. Are these going to be taxed now or later? There's actually a third option, which we need to get to at some point, that's more complicated. But if they're taxed now, it turns out that with proof of stake, it's a big problem. If they're taxed later, which means when they're sold and they're not taxed now, it turns out that basically all of these problems, or a huge number of these problems, go away. And the problems are twofold. One is simply kind of administrative and compliance centered. These new tokens, the way blockchains work, are coming into existence. In Bitcoin, they're every 10 minutes. They can be every few seconds. They're coming to existence. So you have immediately an administrative and accounting problem, which is to keep track of these. Because if you go with the approach that they are income when they come into existence, suddenly you have a valuation question. And that question, getting to your earlier point, does not simply apply to a business that's in the business of Bitcoin mining and is set up for this. But the whole point of proof of stake is to bring in token holders into this entire process to help secure the network. So this is a phenomenon that suddenly affects quite possibly a great majority, approaching all of token holders based on kind of the consensus mechanism that is proof of stake.
Yeah. And I feel like, so the classical paradigm of income is, for most people, their wages, right? You've got a day job and you earn money and you get paid maybe every 2 weeks or every month. And I think like early understandings of cryptocurrency were often wrong in an interesting way. I think a lot of people in the early days thought that mining was this weird thing where you just like, you're doing something completely useless. Like the people would talk about the SHA-256 hashing algorithm is completely useless. This is garbage. And you're getting these magical trinkets out of thin air, not in return for work performed, but really just because there's this weird game that this is the way Bitcoin is set up or something like that. And so like that was a misconception because, as you say, cryptocurrency networks are these beautiful, new and interesting public goods that deliver a real service without there being a corporation providing that service that fully internalizes all the costs and all the benefits of the service provision, right? And so unlike a corporation where you'd have workers who are performing the tasks to make the corporation capable of providing the service, like woe unto the people who have to analyze every tweet on Twitter to see whether it's discriminatory or things like that, because that's a huge job and they need to be paid, right? But instead of Twitter, we have Bitcoin for moving money around. And instead of employees who are hired by the Bitcoin Corporation or a proof of stake network like Tezos, instead of employees who are hired by the Tezos Corporation to check transactions are valid and non-fraudulent and add them to the blockchain, you just have people who pop up and are willing to do it voluntarily. And then the protocol has to have this baked in reward to incentivize people to do it. But when we say it like it's like a reward, this gets to what I was thinking is like kind of the second misunderstanding maybe is it's easy to then, once you've gotten beyond block rewards are magical trinkets for no apparent reason in a game, to block rewards are payment to incentivize behavior, it starts to look like payments in the wages sense. And so I think there's this intuitive understanding of how cryptocurrency block rewards happen that probably was common at the IRS during the 2014 guidance, which is, oh, well, these people are earning an income by performing work for a quasi-employer who happens to be a decentralized protocol instead of a corporation. And when people get paid for their work in wages, if you will, the block reward in this case is the way they're maybe understanding it, we tax it as income, right? Now you're saying that that's not quite right? Because this isn't like I'm being paid a wage by someone. There's no someone in this case. And it's not even a payment. It's actually the creation of new money, not the movement of money from one person to another, but the creation of new money. And what I thought is like an amazing and long overdue insight in your published research is this statement of, well, if it's the creation of something new, then it dilutes everyone else's holdings in that thing. And that is something you would need to account for in the way we think about whether someone's actually earned something or not, and whether and how we would calculate the amount that they've earned. Is that right?
Yeah, exactly. So, when we think of income, first we think of wages and we think of money, and U.S. dollars. But as we also know, but is less common, property can be income. You can receive property. It's typically barter. And so there are common situations where you receive something and its value counts as income. In this case, the IRS says that cryptocurrency tokens are property. That's correct. There's really no other way to look at it. But it's also interesting that the money-like features of Bitcoin or Tezos have informed the way we think about these pieces of property to the point that where we are now in the short history of cryptocurrency of it kind of making sense. Hey, well, you're getting it, and property can be income, and so this looks like income. And then the other key question is kind of what's, even if not explicit, what's beneath that model. The 2014 IRS guidance gives no explanation. It doesn't say that these tokens are compensation, but that kind of makes sense. You're being compensated, for maintaining the network, and so it kind of makes sense. But I should stop building up the incorrect view of this entire economic system and tell you and get into what's.
I brought it up because I don't think so. There are areas of cryptocurrency policy where someone maybe was actually acting because they wanted to stifle the technology. This is not one of those, I don't think, though. I think the IRS just took a first read and said, all right, well, you're getting paid by someone, so we'll treat it like income. And I think what's important is that we can actually think much more deeply about it and come to a very reasonable conclusion that first assumption is actually wrong, right?
Right. And we'll come back to this when we lay out kind of the implications for proof of stake, because it helps, I think, to understand how it is that from 2014 till now, this hasn't been a bigger issue than it is, because we're asking to kind of course correct, or almost certainly course correct, with regard to that earlier view of things.
So why would the fact that this is newly created value as part of a sort of total network value matter for tax calculations? Right.
So a little bit of perspective on this is in a moment, kind of walk through why this is so critical for cryptocurrency in particular. Proof of stake, and why nobody should want there to be taxable events every time a new token is created out of thin air. And that's kind of one piece of it. I have yet to talk to somebody in cryptocurrency who's thought about it, says, no, I think that's right. There's questions about what the law is or should be, and we're going to talk really about what the law is. But what's important about the avenue, the solution that I propose, is that it's available under existing law, right? It's not a situation where we're asking for a wholesale change or a carve out from generally applicable principles that under some unique special situation. So what I'm arguing is that we go to kind of a fundamental observation about the way the income tax works and the way we have always thought about income, which is different than a wealth tax and different than other conceivable taxes. And that is to observe that even though it's basically not written down anywhere, but new property is never income to the person who creates it, discovers it, first owns it.
Right.
And that's so fundamental that we don't think about it. And so the examples start with kind of evocative ones like farming and crops, new livestock. And those kind of meet our intuitions particularly strongly. But the important thing is this is across the board. It's any property. It's manufactured property. That when a widget comes off the assembly line, that's not income. It's wealth, and it might be accounted for in different ways under different systems. When you write a book, when you finish it, that's wealth. It's valuable. But we would never think, well, that should be taxed at that time.
Right.
So it's actually a very broad principle. And part of the explanation or it's tough to talk about explanations because in my research on this, I've been digging for, opportunities for case law and stuff to even touch on this issue. And there just isn't very much of it there. There's some tangential doctrines which lead to some insight about, imputed income, and the treasure trove regulation is, provides some kind of ways
breeding
of
herds of cattle, right? Another area.
Yeah.
Well, and I think the reason why there's not much case law here, correct me if I'm wrong, is because it was just so plainly obvious in the physical world that if you were the IRS and you were trying to come up with reasonable tax policies, or you were Congress and you were trying to come up with reasonable tax statutes that the IRS would enforce, and you started thinking, we could tax every ear of corn as it appears on the stalk instead of taxing the farmer when they sell their giant truckload of corn at market, you'd be laughed out of the room. People would say, like, what the hell? We're not going to have accountants walking through the fields and like, that ear is not fully grown yet. Oh, that one is. So that's a taxable event right there that just happened. And so it's obvious in the farming situation. But I think a lot of people, because of this metaphor we were talking about earlier, where it's kind of like you're receiving Bitcoin or Tezos or whatever in payment for work. It's a little bit like wages, but it's actually much more like growing ears of corn on a farm. It's like it's all something you do within the confines of your personal space. You've got computers, you've got something that you're staking or you're doing work. You've got new value that is coming from your labor, and it's all happening within your sphere of control. So having that as like an external event that could be accounted for, it would be extremely costly, just like it would be extremely costly in the context of corn farming or what have you. But it's less obvious off the bat because this stuff is new. And with new tech, we have to come up with metaphors to understand it. And sometimes the first metaphors we come up with are just wrong, right?
Wrong. And think if, the other thing that leads us to the wrong conclusion is the existence or the apparent existence of a fair market value, right? So had the IRS been forced to answer this question in 2010 or 2011, maybe they would have gone along a thought process a little bit more different, because the obvious issue is, well, we don't know if property has a value. And as we know with tokens, they may not have a value tomorrow, which leads to another one of the very serious practical and administrative issues with the current conservative understanding of existing law. So that just to explain how it makes sense. It relies on this fact of a value of the features of a new Bitcoin as a piece of money that help lead us to that conclusion. Right. But it's
unlike corn, which, like one ear could have a commodity type price, I suppose, but we all recognize that like there's different kinds of corn and there's different grades and all sorts of, it doesn't seem very fungible. And so it doesn't seem like it'd be easy to account for its value as it appears in your field, let alone the fact that they're appearing like all over your field and at different times of the season. But with Bitcoin, you're right, I think, or with any cryptocurrency, the idea of them being money sort of, and money classically is this perfectly fungible unit that always is worth the same, maybe makes it seem as though it's more feasible to treat every incoming new unit of money as income when it's created rather than when it's sold at a particular price. But of course, that's not right either, because these things don't always have a common value and the value fluctuates. And the value fluctuates so much that, I mean, just as one pernicious side effect of treating each block reward creation event as income, you're going to want to sell it as soon as possible, right? Because if it's income then, you owe income then.
At that valuation. Yeah.
And 2 days later, the price could plummet or it could skyrocket. It could do either, because these cryptocurrencies are volatile in relation to the dollar. And that's all risk that you're taking on if you don't sell it immediately for its current market price at the moment when it is going to be taxed, if that's when it's going to be taxed, if it's going to be taxed at that moment, if that's the reading of the current IRS rules that you want to take.
Yeah.
So it's interesting that you say that like we don't necessarily need to change current law to treat this as income when it's sold, which could be months or even years later, rather than when it's created. How does that work? What is the current?
Well, that's the argument, and I should say, like, certainly legislative clarity and so on, and there's some subsequent steps as we expand this principle that may would certainly benefit at least if we got the right policy of having it enshrined in law. But how it works under existing law is just to say, hey, this is new property. It's like new property, like anything else, and I own it because I created it, and when it's sold, there'll be a gain like anything else, and that's when you tax it.
So you make it sound so simple. Does the 2014 guidance sort of put the kibosh on that interpretation? Like if I was to take that interpretation on my taxes now, and this is not tax advice for anyone listening, we should put this disclaimer out there. But if I was to do this, because I think that makes sense, that's the most reasonable metaphysical way to think about block rewards, is that they're like created property that I owe at the time when I go to sell, not when I create it. Does the 2014 guidance make my choice to do that seem suspicious or wrong or less likely to succeed?
Well, it's unclear in a sense, but it's important to think about what that guidance is. First of all, and this is it's guidance. It isn't. It's been described legally, that type of FAQ and informal guidance, as a press release.
For our listeners, we just in the previous episode talked about the Administrative Procedure Act, regulations, and guidance as compared to law, as compared to actual law passed by Congress. So this is not what Congress wrote. This is what the IRS
it's not even it's not a regulation either.
It's not even a regulation.
No, yeah. And this is very important. If their the Treasury regulations are law.
That's right.
An IRS FAQ is as some have called it, a press release announcing the IRS's approach to it. And what that means for our listeners, that means that statement on the piece of paper is not even persuasive in a court. It's entitled to zero deference, and the IRS won't claim it is entitled to deference. Now, of course, in a typical situation, we expect that they have the analysis and have a position. And if you're being told, hey, we've thought about something and this is our position, you're going to take it seriously. But those distinctions are critical here. Yeah. But nonetheless, that guidance has incredible practical implications, in part due to a little bit to lack of understanding its status, but also to, there's two categories of people out there, ones who don't really know or care what the IRS might say, and others, especially bigger players and institutions, who care very, very much and are seeking advice that's consistent not only with what the law ultimately is, but practical considerations and, taking a support that's likely to be safe. I mean, this sounds absurd, but it should also mention that the IRS is not bound by that statement. If they changed their mind, like if they could go after you for obeying that guidance in theory, right? So just to be clear about its status, but in a world with a lack of clarity and a desire to toe the line, it's incredibly persuasive.
And so that's what they've said on it. And then with the underlying regulations and the underlying law, it's open to you taking the approach that you want to take, right?
Yeah, and I'll give a little background on how I got involved in this issue. And I work very closely now with the Proof of Stake Alliance, which is another organization with focuses like Coin Center on education focused around proof of stake in Washington and on different regulatory issues, and we can touch on some of those. But with the timing of my article coincided with some efforts of POSA, the Proof of Stake Alliance, led by Evan Weiss, and I was able to participate and present my paper at the Department of the Treasury's Office of Tax Policy soon after it came out. And that kind of got some exposure to these arguments. But in the bigger picture there, that meeting was also to explain, hey, there's this thing called proof of stake.
Right.
And it's different from proof of work. And of course, a lot of people don't understand proof of work either. So so it was also just an educational initiative. So working with POSA and with follow up in the IRS, we had some surprising success in a good sense in getting an audience and having the opportunity to walk through the implications of this. And I should mention, as I said, there's kind of a compliance and administrative element to this. And then there's the overtaxation element, but there's something really immediate about the compliance issue. And something that's important is this is not just for taxpayers. This is not just a hassle for taxpayers. If you are a Tezos token holder and you are acquiring new tokens over the course of the year, and you suddenly have, depending on how many wallets you have and how you're delegating, hundreds and hundreds of taxable events where it's up to you to go back and figure out the value of those new tokens on that day. That is a compliance nightmare. And again, now where every token holder might be subject to this, not just specialized miners who are already in a business and so on. But this is a burden on tax authorities.
Yeah.
And a question for their credibility and ability to maintain a credible system. And then you add to that the incredible diversity among these protocols on highly technical, fact-specific details, which maybe we'll have time to get into, in part just to illustrate the can of worms that is awaiting for us, that people are starting to become more aware of if we go down that route. So in a sense, that practical element, even though the overtaxation thing is really kind of the core of my argument, but that practical element is really important as well, and I think helped us to really get the attention required to go that level deeper. And I should mention that we have ongoing efforts, and working along with the Proof of Stake Alliance, I spent a lot of time spreading this message, trying to find people who find this interesting enough to care about why it deserves to be the third on the list of Coin Center's tax priorities as well.
I didn't mean third as in like third priority, just three.
Well, right.
They're
only the third to make the list. Yeah.
But yeah, no, it's interesting you bring up the practical implications for the administrator, for the IRS, because I think this is something that folks who don't come to DC and explain cryptocurrencies and things to policymakers don't necessarily realize is the straining for good policy here, whether it's in securities law or anti-money laundering law or tax law, is not just trying to get simpler rules for us users and enthusiasts to be able to better comply with the law. It's to minimize administrative costs too, because a complicated rule that would require a lot of like door to door, like you're non-compliant, you seem compliant, you're non-compliant, because you need to judge this in each individual case, is not a good rule for the IRS either. It's not a good situation. And I think this, so when you and I first talked about this, I totally understand. So as a preface, we've sort of said this throughout, and we'll maybe talk about this more fully, but I think this theory applies equally between proof of work and proof of stake. It applies equally well that you're creating something, and so therefore it should be taxed when you sell it, not when it is created. But that said, the practicalities of a proof of stake network and trying to tax it as created are much more dire than trying to tax Bitcoin when it's created. Because as you said, a typical Bitcoin mining situation is going to be a professional of some sort, because the hardware that you're going to need to be competitive with,
if they're going to pay taxes.
Yeah. Well,
if they're going to take account. Yeah.
Well, I mean, a few things. So they're going to be a big business that's going to have a lot of computer hardware. They're not just going to be some individual who's doing this as a hobby. Generally now, maybe in the early days there were hobbyist Bitcoin miners, but there aren't any now, because you just need too much capital up front to do this. You're going to do this as a business. You're probably going to do this in China, right? Or maybe in Iceland, or maybe in the Pacific Northwest or in Texas, where electricity is cheap in America to do this. But it's quite often that you'll be overseas, and then this isn't even an issue for the IRS necessarily. We can get into edge cases, but we don't need to. And you're going to get a block reward fairly seldomly, right? I mean, blocks come around every 10 minutes, we should hope that you're not getting them every 10 minutes because that means you're dominating mining and you're like all of mining. So maybe I don't know what the average is, but if you're a competitive Bitcoin miner, maybe you're getting a block reward like once a day or such. And so it's still difficult to calculate the current value of Bitcoin at that moment once a day. But with proof of stake, all of those assumptions go away. Like a proof of stake staker is quite possibly like someone like me in their house in Washington, D.C., and I keep a computer online over there, or maybe I delegate and I don't even have to keep a computer online, but you don't need specialized hardware. I might be getting small rewards from the protocol, depending on whether it's Tezos or whether it's a different proof of stake network, every few minutes, every few seconds, even potentially. And each one is a tiny little reward. The administrative costs then for me of accounting for all of those income moments at the moment when they happened, at the market price of the moment where they happened, is astronomical. But even worse, and this is why it's important when you talk to regulators to help regulators realize their own interests here in having good faith compliance and an ability to enforce the law. How are they going to know that I had are they going to go do deep blockchain analysis and figure out what every address on a network is and who got each reward every few seconds on a protocol? Are they going to do investigations like that? That is a nightmare for them. Much better if I'm taxed when I take all the Tezos that I've baked over the last year and say, I need to actually, sell these now. And there's just one taxable event rather than quite literally thousands, or even, I don't know, I haven't done the math here, tens of thousands. Like, how bad could it be?
Yeah. And the one thing I would add to distinguishing the Bitcoin and proof of work situation is even though they may be involved in a pool, and so they may indeed have kind of a steady flow of tokens. I don't know exactly
That's true. There's
how it works, but they're selling them anyways. If not all of them, enough to cover these ongoing costs. I mean, that's also part of Bitcoin miners.
Yeah,
and they need to. And so the problem goes away there, because you might as well pay the tax then if you're already selling, because you're selling it, and then you step up your basis in those new Bitcoins and you go forward, and if you keep them at all, or the ones you do keep, and everything works out fine. And that's not the way it works in proof of stake at all. Especially once we understand and get to this next level of appreciating how the incentive mechanism works, and that it's less ultimately, at least in certain proof of stake protocols, it's less about earning, creating whatever new tokens, but rather about maintaining one's stake in a network where, as a function of the method used to incentivize this group behavior, the number of tokens is going up. Right. So if you start the year with 100 tokens and there's going to be 10% new tokens in the system, you're treading water if you end the year with 110 tokens. So you don't want to sell them. Although the real point there is you don't want to sell them. You shouldn't have to sell them because it's not income, because your stake in that network has remained the same.
Yeah. This aspect of the analysis is really sharp, but also kind of hard to comprehend for people. Because people don't normally think about, we refer to it as inflation or deflation, but people don't normally think about that when they think about their wages, which is actually a big problem. And it's why Keynesianism works, right? Because you can convince workers to do more work for less money momentarily, and that stimulates the economy, which is kind of crazy. We don't have to get into Keynes, but yeah. So you had a good hypothetical, I think, where you said you could design a proof of stake cryptocurrency differently, right? You could design a proof of stake cryptocurrency where there is no reward. There's just a cost to not staking, right? Explain how that could help people understand how these networks actually work and really illuminate why it's insane to tax these things as they're received.
Good. So first, a different level of looking at this. The problem with tax, one way of looking at the problem with taxing these new tokens as income is these new tokens dilute the entire stock of the cryptocurrency. And while you can put a dollar value on that new token, which is what the government might do because you have realized it. And the question is, have you realized this income? But what is not recognized there is the dilution that has affected the other tokens that you own. And we know you own them because this is proof of stake.
You have to.
This is the whole plan of proof of stake. So we know that dilution is happening. And so from one angle, the problem here is identifying this new token as a taxable event and excluding the bigger picture. The purpose of this example, and part of it is to make the argument, which I think is persuasive to a lot of people, including some I've spoken to in government, is, look, this is an incentive mechanism. There's other ways to do it where we could remove what appears to be a taxable event, a realization event, and your tools aren't, the existing tax law doesn't have the tools to go after the true economic activity there. And so the simple example is, instead of getting new tokens by, if you're a validator, you don't get new tokens, but those who don't participate in that maintenance get slashed or have a portion of their tokens burned. So what you end up with there is a situation where the validators increase their stake, their percentage ownership in this network, but there's no realization event. So there's nothing to grab onto to say, hey, you're increasing your wealth. Now, it gets more complicated if we look at the tax treatment of these burn tokens and so on. But the point is, and this is what we don't want, right? We don't want cryptocurrency to
be designed in cockamamie weird ways.
Merely to address kind of a misunderstanding at the regulatory level about the nature of this incentive behavior. That would be terrible.
And correct me if I'm wrong, but that would be pro forma too, because these two hypothetical networks, well, the real version where stakers earn and non-stakers don't earn but suffer because of dilution, is functionally identical to a network where stakers don't earn but don't suffer dilution or don't suffer slashing, and non-stakers do suffer slashing. There is no real difference between those systems. There are nominal differences.
Yeah.
And the tax law, and I don't think anybody at the IRS would disagree, should recognize real income events or real differences in wealth, and should not be hung up on nominal things like, oh, you have 5 more tezies. But tezies aren't worth as much because these are 5 brand new tezies.
Yeah.
The real thing here is that differential. It's not the nominal change in amounts between me and somebody else per se, right?
Mm-hmm.
And so we could fix this, right? We could still tax when it happens and account for these dilution. It would be really hard, but we could do that, right?
We could. And, as I was mentioning before, we've had a receptive audience at the IRS, and we, being working with Proof of Stake Alliance, we actually have a challenge underway right now administratively with the hope of clarifying this and getting a decision out there which addresses and hopefully solves this problem while there's still time before.
Now, interesting. So I was saying we could fix this even if it's taxed as it happens. You could try and account for dilution. You could try and account for all that. But isn't it easier just to fix this by saying that there's no taxation until you sell, right?
Right. Yeah, it's important to recognize that point. So if you tax the fair market value of these new tokens, we can show that that's overtaxation. And the correct solution is to tax them at the end. And that fits with the way, without noticing it, we've always taxed new property to avoid problems with valuation and so on. Not this precise problem with valuation, because cryptocurrency is unique, but actually similar ones of, when do you value it and how? There is a middle ground, which is to say, well, let's find out what that token holder's actual gain was by accounting for this dilution. And to further the case that this is not a path that we want to go down, I published a paper this summer with an economist to go through that step and show what it would look like. And it turns out it's extremely complicated. So I've got some simple models which describe it in the abstract, but once you account for time varying balances and other factors that vary through time in a real world situation, if you were going to try to assess the actual gain of participating in these networks over time, given this fact of dilution, it's a fool's errand. It just doesn't make any sense.
And so you can address the same issue. You can get to a more fair accounting for the amount that was actually gained, not necessarily by calculating just in time right when it happens, but simply by taxing when they sell, because that's when we are clear about the realization event. That's when we really know that this person, through their labor, created this value, and now they're realizing their value, and now they should owe taxes, right? It's much simpler.
It solves everything. It's just all in one, because the effect of dilution on one's existing tokens and new tokens, it all comes out
in the market price.
In the market price at the end.
Yeah. And so better to use markets to figure that out in real actual events where the market puts a price on something than to assume it based on the current state when the thing was created and the amount that it was diluted of your current holdings and all. That's crazy. Like, you have this great mechanism in the market to figure out the value.
And we've been using it for everything else.
And it would make the IRS's job easier, because it's much easier to figure out when someone sells something and their bank account increases than when a block reward is given in a protocol that has block rewards every few seconds, and they're in a different asset value. They're not in dollars, they're in whatever they are. So it makes so much more sense. Are you optimistic that we can convince the IRS that this is better for them, better for the taxpayer, and we can fix this whole problem?
I'm pretty optimistic. I think they appreciate it. I think the practical considerations, but it does take, education and persuasion. And one of the challenges is, because the mechanics of cryptocurrency are what they are, there is this tendency to financialize our thinking about them that is particularly present in proof of stake, right? Because we have this new framework for it, and this is where you see people talking about things like yields and saying the word interest or dividends, whether it's meant as an analogy or not. Right. It's a way to make sense of it, because in a proof of stake network, at the end of the day, but not in the mechanics, your new tokens are a function of your existing tokens. And that just lends itself to this way of looking at it. And it makes sense that people resort to this, because the mechanics are so complicated and they're different for different exchanges. So in my work on this, I'm not a computer scientist, but going through the exercise of really at the nitty-gritty level, demonstrating and illustrating what is happening on a blockchain. Why do people do these certain things, and what causes a new token to come in existence? It's the important narrative that people need to understand, but it's too complicated, and it varies by every blockchain. So I've gone through this exercise, for example, with Tezos. Cosmos is another one that's very informative, because it presents another factor of complication for the default conservative model of treating these things as income. But the actions...
Why is that? Is that because there's slashing in Cosmos, or?
No, it's because in Cosmos, there's instant finality, which means that even in Tezos, there's new tokens that come into existence each minute, but due to very deep reasons of finality, they're frozen and released on a certain schedule. So probably that means actually with Tezos, you don't have to, you want to account every minute, but as it turns out, every three days, because that's when you get your dominion and control over this new property. But Cosmos is different. It's fascinating, and it works toward instant finality. But by doing that, it turns out that everybody involved in this process, every token holder who is staking and contributing to the security of the network, shares in the new tokens created every 6 seconds.
Wow. Yeah. So tons of taxable events, all very tiny, all hard to account for. It would be
hard to account for. They're literally impossible, because it's so much data that the amount of new tokens that are owned by, and they are owned by and controlled by a participant, isn't actually finally calculated until they request them.
Yeah. And I think, and so we got into this as like, how optimistic are we? And I think that this is cause for optimism, although people might see it as cause for pessimism. You're like, oh God, this is so complicated. Like Cosmos is different than Tezos. And I just know about Bitcoin. I don't even know about proof of stake. I just know proof of work. There's a simple solution, whether you're a regulator facing this incredibly complex landscape or a taxpayer facing this incredibly complicated landscape, is to just treat this in a common sense fashion, which is sell it and then be, taxed on the moment when you sell, not on this creation moment. Because, you can think of the complication here of like, oh gosh, I've got peas growing in my garden and I get three harvests a year from the peas because they keep growing, but then the corn is all at once in August. Mm-hmm. This is why we don't tax vegetables as they're grown. We tax them when you sell them. It's just simpler. And so it should just be simple. Even we don't have to ask what's the difference between Cosmos or Tezos or Bitcoin. Yeah. You don't even have to ask the difference between proof of stake or proof of work. We just say, look, a common sense way to get the IRS all the revenue that it wants, the same as before, but just do it in a simpler way, is to do it at sale, right?
Yeah, it applies across the board. We don't want to do, and by the way, until we get to that point, the alternative of treating it as income immediately opens up an entire other smorgasbord of practical complications that people also are paying attention to. And I don't know how deep we want to go into it, but the basic model in proof of stake networks or common model is kind of a two-tier thing, whether you call it delegation or whatever. And so you have relationships, right? And we understand why we do this. It's to accomplish the decentralized participation and make sure that no one's in control of it. The entire system, but then you get into detailed factual questions about whether, say, the validator to whom tokens are staked or delegated touches those tokens and makes a payment to the delegator, or is it the delegator who's making a payment to the validator for doing something,
right?
Or is the validator's payment to a delegator a compensation paid from the validator? And all those you can see, but all those vary from protocol to protocol.
And important to note that there aren't traditional legal relationships between these participants. There's a protocol relationship between these participants. There isn't like, again, just like a Bitcoin miner doesn't have a labor contract and a wage contract with the Bitcoin protocol, you don't have that with your delegator, or this is the same in mining pools. People don't sign some agreement with their mining pool operator, which is interesting that they don't, because there's a lot of centralization and trust in a mining pool situation potentially. It's still just like, no, I give you like SHA-256 calculations and you give me Bitcoins. I don't know who you are. You don't know who I am. So figuring any of that out is really hard. It's really hard in the delegation context. And again, the IRS could get all the revenue that it gets and wants and do this simply if you just tax the person who delegated to somebody else as they receive their delegation rewards. Just like you don't need to think about whether it's a delegated staking situation and they're earning rewards from delegated stake, or they're staking themselves, or they're mining in a pool. You don't need to think about any of that. Yeah. Just tax when they sell.
And part of the problem here is, even though this is the way we should look at it, that's often not the way lawyers and accountants do look at it. They look for problems, and it's easily to problematize this. And partnerships, unintended partnerships. Well, okay, you don't need to have something in writing for it to be a partnership with tax and other legal implications. So therefore, maybe that's what this is, and so that just opens up a whole bag of worms. Again, incredibly fact dependent on what's going on in a protocol, and there's an easy way right in front of us to avoid this whole rabbit hole.
Yeah, and it wouldn't mean any less revenue for the IRS, right?
No, it's time shifting it basically. I mean, it's fascinating as I've learned about these tax issues. So much of tax is a question of when, whether it's taxed now or later, because and there's ways of deferring it forever in certain contexts, and but that's really what it comes down to.
And in this context, I feel like it would probably mean more revenue for the IRS because complex rules that are difficult to comply with will have people weaseling their way out, underreporting, maybe even just saying, screw this, I'm going to do this overseas and try to avoid US taxation. A simple rule, though, where, I have been staking for all this time and now I want to stop, or I want to take my staking rewards and I want to sell them on Coinbase. All right, yeah, I'll pay taxes on the big lump sum thing I earned on Coinbase, because of course I will. That's simple. It's easier. More people will then comply. The IRS will get more money, I'd say.
And that's the most important argument, frankly, right there. But there are other ones too, to the extent that people say, well, this is deferring the government's receipt of its, something it's entitled to, that are more detailed arguments. And turns out that's not the case, because with this dilution effect, that dilution effect is affecting people who are holding their tokens. Now, again, for them, it all comes out in the wash when they sell, but the effect of taxing the new tokens now, but postponing the recognition of losses from those who have been diluted until later is actually an asymmetry in the tax code, which is not, in my argument, is not justified. It actually can be different in various situations where the law has adapted to ensure or encourage the payment of tax on, say, certain types of corporate gains through various types of dividends and so on. And so, again, it's an example where these analogies that we naturally go to toward dividends, or in particular stock dividends, which are dividends in the form of property, are immediately available, but often not apropos.
Yeah. Well, I think we've reached a good stopping point. We're coming up on an hour. We're going to have you back, Abe, because you and I wanted to talk about a few other things, but we'll have you back for a future episode. And I'm glad you're optimistic. I'm optimistic. There was a letter from some members of Congress to the IRS stressing that the IRS should look at these problems that you've raised and think hard about them and come up with common sense solutions. And I think the work that you and Evan at POSA are doing to educate the IRS on these issues specifically is invaluable. Coin Center is trying to do its part as well now. We've published some of your work on our website, and whenever we get a chance to talk to the IRS, we bring this up as well. So thank you for sticking up for common sense regulation of cryptocurrencies, because God knows we need more common sense in this space.
Excellent.
Thanks for coming on the show, Abe.
Thank you.